Hi all. So today we are going to see monetary policy versus fiscal policy. This comes under macroeconomics. So we'll see now what it is. So first we'll understand what is monetary policy. So monetary policy. So this is designed and laid down by central banks. So basically RBI. So the purpose of monetary policy is to shape the investment and spending decisions of the consumer and businesses through changing the money supply and interest rate of an economy. For example, during the recessions, the interest rate gets down on the loans, but after recession, once the stability comes in the economy, interest rates goes high. So, for example, after COVID, even the banks has raised their interest rates 2 to 3 times in a year this time. So these all comes under monetary policies. So central banks achieve their objectives in two ways. So either regulating money supply or regulating the interest rates. So the Federal Reserve in United States, the Reserve Bank of India, the European Central Bank, the Bank of England, the Bank of Japan, so are these are all are responsible for monetary policy in their respective areas. So their decisions are therefore crucial to their economy, which is why there is major often news that coverage about the decision that they make, because based on that decisions the behavior of the people living in that country or that region changes. So based for example, if the interest rates goes high, people avoid taking loans, but whereas when the interest rates goes down, people try taking loans for multiple purposes. So this is how the decision of banks also changes the behavior of the country, the people in the country. So regulating money supply in the market, so how they do it. So the central bank buys the government bonds and the securities to increase the money supply in the economy. So this is also known as quantitative easing, which is a measure to increase money supply in the economy to boost the economic activity. So this injection leads to a decrease in interest rates as bank have more liquidity now, because they have more money and they want people to take that money. They want to release that money in the economy. So they have to make the interest rates low. So that is how they'll behave. So this in turns boosts the GDP. So when the Federal Reserves in USA resorted to quantitative easing after the financial crisis, it bought lots of different long-term securities to increase the money supply. Effectively, when this happens, the Fed buys a bond and creates dollars to pay for it, thereby increasing the amount of money in the circulation. So this is how they regulate the money supply in the market. So this was all about the monetary policies. Now we'll see what is fiscal policy. So fiscal policy refer to the spending and taxation, borrowing that government uses to tide over the economy through the fluctuations in the business cycles. So basically here government plays the important role. So fiscal policy is highly political in nature and can be difficult to enact due to the involvement of several stakeholders and interests. So, as you make out from that definition, the governments are the key actors when it comes to fiscal policy. So, government spending decisions are based on the fiscal policy appointed by the government. So, why doesn't government spend an infinite amount of money to keep growing its GDP? So, the answer is the government uses deficit spending. That means it borrows money, which means that additional debt which government has to pay back. And the other is crowding out effect. That means higher government spending leads to higher interest rates. So now we'll see the types of fiscal policy. There are two types of fiscal policy. One is expansionary and the other one is contractionary. So what is expansionary? It is implemented during the times of recession or the slow economic activity like COVID in order to stimulate the economy and increase aggregate demand. Then the opposite of it is contractionary fiscal policy. It is implemented during times of strong economic growth in order to increase the government saving through higher taxes or lower spending. So this was the types of fiscal policies. So basically, we have seen that the monetary policy there, the central banks plays the important role, whereas when it comes to fiscal policy, the government plays the major role. So this was the main difference between monetary policies and the fiscal policies. So thank you so much for watching this video, and please do like, share, and subscribe to this channel.